In engineering fields, we can measure almost everything, from body angles to velocities, accelerations, blade rotations, or wing deformations. But no measurement is perfect. Signals are often contaminated by sensor noise, which may appear as high-frequency jitter, white noise, or other unwanted fluctuations from the environment, or imperfections in the sensor devices themselves. In this context, noise is objective. There is a real underlying signal that we are trying to estimate, even if we can't measure it perfectly. In finance, however, it's a complete different story. There is no ground truth signal. Here, noise simply means anything our model can't use. And what's noise to a pension fund might be pure alpha to a high frequency trader or a day trader. Welcome to Alpha Quant Solutions, the platform where markets meet science and engineering to deliver your investment edge. We want to make the claim that in engineering, noise is objective. And what you see here on this slide is two pictures. On the left, the cockpit of a modern aircraft, and on the right, the control of a modern sail ship. And in both, you see lots of displays and indicators, and each one of them is linked to one or several sensors. So we say that in engineering, measurement noise, also called sensor noise, refers to random, undesired fluctuations that corrupt the true signal being measured. Further, it is typically caused by imperfections in the sensing device, environmental disturbances, or limitations in the measurement system itself. So here is an example of measurement noise in engineering. We have here two graphs. The top graph with the clean blue line, which is the true signal we're trying to identify or measure or detect. And the bottom graph is actually the output of the measurement device, so the output of the sensor. So you see basically the output is the red signal, which is the blue line with an additional noise that we have added on top of the blue line, and the result is the red line. Is this additional noise is what we usually tend to model in engineering by calling it an additive noise, and it's typically modeled as a Gaussian white noise. So a Gaussian white noise is a type of random signal where each value is essentially unpredictable and unrelated to the others. And the term white means that its energy is spread evenly across all frequencies, like a white light contains also all colors. So each frequency has equal power, basically. That's what is meant by white. And finally, the word Gaussian refers to the values of this noise, which follow a bell-shaped or normal distribution. So this Gaussian white noise is a common model for unpredictable disturbances in science and engineering. Quick disclaimers. We do not give investment or financial advice. We are only sharing our personal opinions. Now, in engineering, let's summarize the key characteristics of noise. And on the right, you can see a picture showing some sensor devices. So these characteristics, we will group them in 5 ensembles. So the first ensemble is about the statistical nature of noise. So we will here characterize it as randomness. So this means that the noise is unpredictable in the short term, even if its statistical properties are known. And by randomness, here another word for it is stochasticity. So it means that the noise is not deterministic. The second aspect of statistical nature is about its distribution. So often we assume a Gaussian or normal distribution, but we could also use other ones. It depends on the application, for instance, Poisson distributions. And then finally, the first and second moments of this distribution, so the mean and the variance. So for the mean, We often assume that it is zero, so this means that the average over time of the noise values are zero. And then the variance is a metric used to basically assess its power or intensity. Moving now to the second part, the spectral content or frequency content. So here we have three options. Either it is white noise, as we described just before, so this means equal power across all frequencies, a flat spectrum. Or it is colored noise, so this means that the power depends on frequency. So we could have pink noise has more low frequency content, or blue noise has more high frequency content. Or it is narrowband noise, where it means that actually the noise is concentrated around certain frequencies. And so it really depends on the applications here. For instance, when we deal with robotics or aeroplanes or aerospace applications, then often we assume white noise when we deal with sensors like accelerometers, and when we also want to use Kalman filters, where we model the noise of accelerometers as white noise. In other applications, when we deal with engine vibrations or wing vibrations in airplanes, or blade or propeller vibrations in helicopters, then we often deal with high frequency noise. So then we have more of a so-called here blue noise, where you have more frequency in the more noise in the high frequency domain. And then narrowband noise is could be, for instance, the case where you have flap frequencies of rotor blades in a helicopter that are harmonic, that tend to be at certain levels of frequencies. So that could be another third option as well. Moving to the third component, so now we could either describe noise as additive or multiplicative, and often we use the additive noise definition, so by simply adding the noise to the original clean signal. So basically what this means is that the measurement is actually equal to the clean signal plus an additive noise. Next, we address the stationarity properties of noise. So in engineering, we often assume that the statistical properties do not change over time. So metrics like mean, variance, spectrum of the noise are constant. And finally, about the correlation structure, also here we also assume that there is no linear relationship between the noise values at different times. So we also assume in engineering that we have uncorrelated noise. Based on our previous slide, I thought it might be good to have a quick reminder in terms of the definitions and the terminology we use when we refer to the relationship between two variables. So let's start with two variables x and y, and we will ask the following question. Are these two variables stochastic or random? If the answer is no, then this means that these two variables are deterministic. Now, the next question we can ask, is there a functional relationship between these two variables? And if the answer is yes, then we could either have a linear correlation between these two variables or a nonlinear relationship between x and y. Alternatively, if we say that these two variables are actually random, or in other words, stochastic, then the next question we can ask is, are x and y independent? And if the answer is yes, then we have stochastic independent variables. And this means that we cannot have linear correlation, and we also cannot have nonlinear dependence between x and y. Now, if x and y are not independent, then we get this side of the tree. So we have stochastic dependence between x and y. And in this case, we can ask the following question. Is there a linear correlation between x and y? If the answer is yes, well, then we have linear dependence. If the answer is no, then we have dependence, but uncorrelated variables. So this implies a nonlinear dependence between the variables x and y. Now we are done with the engineering part of the video, and now we're going back to finance. So here we want to revisit a table we introduced in a previous video where we talked about the three time frames that define financial markets, or the way we like to call it, the trinity of market behavior. So before going into what is noise in finance, we first want to review this table that basically identifies three groups of trading and investment strategies, depending on the time horizon of these strategies. So if the time horizon is between milliseconds and minutes, then we call those strategies as ultra short term. If their time horizon goes from minutes to weeks, then we call them short term strategies. And finally, from weeks to decades, this is part of the long term trading or investment strategies. Now, in the first category, which we call here also the microstructure zone, then we will find strategies that are familiar. I guess you would expect indeed high frequency trading and ultra short term scalping. And the market participants typically are HFT firms, but also independent scalpers, flow traders, and market makers. The next group shown here in red is what we refer to as the trader's battleground zone. And in terms of strategies, we have intraday momentum and intraday mean reversion, swing trading, short-term trends, event-driven strategies, and statistical arbitrage. In terms of market participants, this is where we will find most of the day traders and retail traders. But we will also find some prop intraday desks, some short-term hedge funds, some quant funds, some discretionary hedge funds, and finally some multi-strategy portfolio managers. The last group shown here in green refers to what we call the strategic investment zone. And here in terms of strategy type, well, we have medium-term trend following, macro allocation strategies, long-term thematic, and then also strategic asset allocation and structural rotation. In terms of market participants, we'll find here commodity trading advisors, global macro funds, sector rotation models. We'll find pension funds, asset managers, institutional mandates, and then for the very long-term ones, it's going to be more about sovereign wealth funds, endowments, and long-horizon institutions. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Now, let's ask this central question for today's video. What is noise in finance? And actually, this is one of the most insightful and foundational questions in financial signal processing. Why? Because if we look back and what we have seen from engineering, we saw that noise in that case is unstructured, exogenous, and often Gaussian. And basically, in engineering, noise is anything we want to filter out because it shouldn't be there. However, in finance, unlike engineering, there is no ground truth signal. So that means that noise is a model dependent concept. Noise in finance is not objective. In finance, noise is anything that does not help our model or our decision making process. As a simple illustration, in finance, what is noise for one strategy, for instance, let's consider a trend following strategy, might actually be a signal for another strategy, for instance, a mean reversion strategy or a high frequency trading system. Hence, in financial markets, noise is strategy dependent. And now we have revisited our table and we have added here an additional column on the right called typical noise. And in the following part of the video, we will walk through this table and see how each market participant, from the HFT to the sovereign wealth funds, actually define what we call noise. Now, for strategies having a time horizon from milliseconds to seconds, what do we define as noise? In this case, for an example, when we talk about high frequency traders, then the slow drift of the market over hours or days is actually irrelevant for them. It's just background static. And even macro trends or most intraday swings don't matter as well because most of your trades live just for a few milliseconds. Next, for strategies going from a few seconds to a few minutes, well, here, if we take the example of scalpers, then the real distraction is big news or shocks or sudden price gaps. They are too unpredictable and disrupt the micro patterns these scalpers tend to hunt for. Next, for strategies going from a few minutes to a few hours, well, here, if we take the example of intraday traders, then trends that last beyond a few hours can be more of a distraction than help. And basically, broad market moves often swamp the smaller reversals that these traders tend to capture. Moving now to strategies spanning a time period going from a few hours to a few days. And here, this is where we'll find most of the swing traders, but also most of the active retail traders. And now, what is the noise for them? Well, it comes from two different components. This is now really interesting because, on one hand, for those traders, we have high frequency noise like overnight gaps or earning news, in this case, or high impact macro news or macro events. But we also have low frequency noise that disrupts their trading setups, like, for instance, multi day trends. Next, for strategies going from a few days to a few weeks, and here we'll find a lot of the discretionary hedge funds or quant funds. What we can say about the noise here is that for these type of strategies, sharp breakouts or sudden earnings volatility can feel random, and also macro regime shifts can also derail otherwise well-behaved price patterns. Here again, we have the presence of two types of noise. In this case, sharp breakouts and earnings volatility can be qualified as high-frequency noise, whereas macro regime shifts can be seen as low-frequency noise. Moving now to medium-term strategies, spanning a few weeks to a few months in terms of time horizon, what we see here is that short-lived volatility spikes and choppy reversals are just seen as distractions, because these type of events tend to hide the longer moves that these traders are trying to ride. Moving now to long-term investors and long-term asset allocators with strategies spanning a few months to a few years in terms of time horizon. What we can see here is that the day-to-day volatility and the short-term sentiment swings are pure static for them. And even the quarterly earnings is seen as noise and is often filtered out in search of multi-year trends. Moving now to strategic asset allocators that use strategies having a time horizon going from a few years to a few decades. For them, everything except deep structural market shifts or regime changes is just seen as noise. And actually, most short-term or medium-term market moves is also seen as noise, and for them, that just simply fades into the background. So, what does this mean for noise in financial markets? Well, noise is not universal, it is relative. So, what we want to here make the case for is that for strategies that have time horizon between milliseconds and minutes, one could argue that the noise is primarily low frequency signal. On the other hand, at the other end of the spectrum, for strategies that go from a few weeks to a few decades, then for them, the noise has primarily a high frequency content. And for all strategies in between, so for time horizons going from a few minutes to a few weeks, one could argue that actually noise has both low and high frequency content. So now that we have seen that, what does this all mean for alpha? So here we want to make the case that alpha is time horizon dependent, meaning that improving the signal to noise ratio at a specific time scale typically comes at the cost of alpha opportunities at other timescales. So let's give a few examples here. For instance, long-term investors, such as pension funds or sovereign wealth funds, apply filters explicitly or implicitly that suppress short-term volatility. In doing so, they may forego short-term alpha, for example, momentum bursts or mean reversion patterns, but this enhances their long-term signal-to-noise ratio, and it helps them target structural macro shifts or secular growth trends. At the other end of the spectrum, we find short-term traders like scalpers and high-frequency traders that are actually doing exactly the opposite of what our long-term investors were doing. So short-term traders amplify high-frequency microstructure patterns and suppress long-duration drifts, effectively discarding what long-term investors consider alpha. Finally, for mid-horizon strategies, like swing traders or hedge funds, well, these might sacrifice both fast and slow-moving components to focus primarily on medium-term inefficiencies. So here, they carve out alpha from regime shifts or temporary price dislocations. So essentially, alpha is time horizon dependent, and extracting it requires filtering out everything else, even if it's alpha for someone else. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Now, in this green area, which is the strategic investment zone, is precisely where we have positioned our company, Alpha Quant Solutions, to extract long-term alpha. And we do that using our quantitative investing dashboard. Essentially, the advanced visuals of our quantitative investing dashboard allow us to derive long-term and rule-based strategies that mimic buy and hold. However, compared to a standard buy and hold, we will only enter positions when the odds favor big gains and limited losses. If you like this video, check also our YouTube video on edge, competition, and costs. Thank you for watching, and until next time.